world makes big mistakes, and surprises happen in dramatic ways. And the more sophisticated the system gets, the more the surprises can be out of right field.
In 2026, investors face some very complicated market conditions. We are looking at heavily overvalued stock markets, an absolute frenzy around AI, an economy that is starting to falter, and a world that is becoming more geopolitically complex and tense than ever before. With all of that happening, now at the ripe old age of 95, Warren Buffett, our go-to source for wisdom, is quieting down as he prepares to hand the Berkshire Hathaway keys over to Greg Abel. In this video, I want to go through exactly what Buffett has been saying about the 3 or 4 big issues we are facing in the year ahead and what we as investors can take away from it. Let's start with the AI bubble. It is no secret that in 2026, we are staring right down the barrel of a potential tech bubble 2.0. The Magnificent Seven companies are roaring ahead and have accounted for 3/4 of the S&P 500's returns since this bull run began back in October 2022. Now, that in itself is no big issue. The problem is that investors are making very big bets on these AI companies, stretching their valuations to extreme levels. Meanwhile, the technology itself is still very immature, and the future is totally unknown. AI is profound. That is what makes it a genie in a bottle. But the truth is that AI generally is so in its infancy that investors simply do not know how it is going to pan out. It is a guess. We don't know what the best use cases are or which companies will come out on top. In fact, even the companies everyone is betting on don't fully know either.
It is profound. That's what makes it a genie. The problem is I really don't know anything about AI.
The story of the past few years has simply been invest now and figure it out later. Just don't be the guy caught in last place having to play catch up. This has led to enormous spending. Take Microsoft, for example. They have spent record amounts in the tens of billions, with plenty more to come. Investors are going along for the ride for the time being, willing to pay up for these businesses. But what these high price to earnings ratios tell you is that everybody expects growth and lots of it. If investors don't get it, you can expect these stocks to be pretty severely re-rated, potentially in the next 12 months, which could bring down the entire market. Interestingly, this doesn't worry Buffett in the slightest. If anything, it gets him excited. He has argued that new technologies coming along don't take away opportunities.
Rise of disruptive technologies and AI being one of them. How do you envision the future of value investing in this new era?
I would argue that there's going to be plenty of opportunities, and part of the reason there are going to be plenty of opportunities, the tech doesn't make any difference or any of that. I mean, new things coming along don't take away the opportunities. What gives you opportunities is other people doing dumb things. Well, the 58 years we've been running Berkshire, I would say there's been a great increase in the number of people doing dumb things, and they do big dumb things. And the reason they do it to some extent is because they can get money from other people so much easier than when we started.
What gives you opportunities is other people doing dumb things. In the 58 plus years he has been running Berkshire, there has been a great increase in the number of people doing dumb things, and they do big dumb things. The reason they do it is because they can get money from other people so much easier than in the past. This is exactly what we have seen in the last few years. Any business with AI in the prospectus has been able to raise loads of money very easily at eye-watering valuations. Established companies have pivoted and sold the dream to their investors. But eventually, there is a reckoning. Believe it or not, this is actually something Warren Buffett wrote about way back in 1999 at the height of the original dot-com bubble. In that moment, people were bidding internet companies up to the moon on the promise of this new technology. At the time, Buffett wrote in Fortune magazine that he was avoiding the internet companies altogether in favor of established companies with wide moats that he knew something about. He said back then that the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. While investors were salivating over companies that ultimately crashed and burned in the dot-com crash, like Webvan or Pets.com, Buffett was sticking to wide moat businesses like Coca-Cola and American Express, companies he still holds to this day thanks to their enduring moats. This leads us to the second major issue: speculation in stock markets. The AI bubble is just one example of a common trend we have seen building up over the past 5 years. The trend of low interest rates combined with increased accessibility to stock markets and options trading has led to the casinofication of financial markets. That is a big driver behind their current overvaluation. For example, the S&P 500 is currently showing a cyclically adjusted PE ratio of around 40. Now, in no world does it make rational sense to pay 40 times the S&P 500's average earnings just to own it. The historical average is around 17. That means investors would typically be willing to pay 17 times the average yearly earnings of these businesses to own them. But to sign up to 40 years of current performance to make your money back, that is a price that investors have only been willing to pay at 2 times in history. The last was in 1999. This has become a real problem for value investors around the world in recent years and will likely plague us again in 2026. In one of Buffett's recent annual letters, he noted that prices are sky high for businesses possessing decent long-term prospects. His longtime business partner, Charlie Munger, put it a little bit more bluntly: "My advice to value investors is to get used to making less." But ever the optimist, Buffett noted recently that because of Berkshire's size and because of market levels, ideas are few, but they are not zero. And this is something Buffett has always spoken about. Sure, if you are confined to only the largest of large companies, or if you choose to only look at the 7 companies you hear about on the news every morning, then chances are you are not going to find much. But look beyond those companies and pockets of opportunity are still there, even in a world of massive speculation. Have a look at the S&P 500 over the past 5 years. It is up significantly, moving up and to the right. But now compare that to the Russell 2000 index. It is a much different story. The Russell 2000 tracks the smallest 2,000 companies out of the Russell 3000. This shows us that once you turn off the mainstream news and instead look deeper to these smaller, less followed companies, the ones that the big money managers gloss over because they are too small for them, all of a sudden, there is a lot more going on that we could potentially sink our teeth into. This is one benefit of modern markets being so enormous. There are always opportunities out there somewhere. It is this very reason why Warren Buffett says that if he had to start again with a small sum of money, he would still be able to generate much bigger returns than even what he does today. The big money is in selling other people ideas, but if you are running small amounts of money, the opportunities will be greater. So the message is certainly to keep our heads up and keep on looking, as opportunities could be just around the corner. And that leads us to the next topic we need to discuss: preparing for a crash. Over the past few years, Berkshire Hathaway has been growing their cash pile to record levels. This has got many questioning whether the Oracle of Omaha is seeing a big economic downturn just around the corner. Berkshire currently holds around $377 billion in cash and short-term U.S. Treasuries on their balance sheet. To give you an idea of how that has grown, 5 years ago, that number sat at just $142 billion. What is interesting is that this increase in cash has largely been from selling down the portfolio over the past few years, particularly lowering their stake in one of the magnificent 7 companies, Apple. Yes, selling down their portfolio in favor of short-term U.S. Treasuries. 3 years ago, Berkshire's portfolio sat as high as $363 billion. But today, they have reduced it by roughly $100 billion. Now, maybe it is just prudent investing, selling high. But interestingly, Buffett has been changing his language slightly over the past few years. He has said that things aren't attractive and that under current conditions, he doesn't mind building the cash position at all. So, what is the deal? Is Buffett holding out for some sort of market correction or a crash? Well, not exactly. It seems as though his moves are just consistent with his strategy. For example, he bought into Apple when it had a PE ratio of about 16, but today that number sits up at 36. That PE value is demanding a lot from that business over the next few years, so it makes sense to take some of those enormous profits. But seriously, $377 billion on the sidelines seems unnecessary. And it is. But this is more the result of not being able to find opportunities at the current time rather than selling down in preparation for a crash. He only swings at pitches he likes. Having said that, There is a very real possibility of some market turbulence in 2026 due to the state of the world at the current time. We have the Fed having to navigate rate changes, conflicts continuing in Europe and the Middle East, deglobalization occurring around the world, and tensions rising in Asia. There are a lot of potential catalysts that could trigger a correction in an already stretched stock market. This leads Buffett to give us this sage advice. Certainly in the next 20 years, you will see a period that will be what someone described as a hair curler compared to anything you have seen before. It just happens periodically. The world makes big mistakes. Surprises happen in dramatic ways. That is part of the stock market. And that is what makes it a good place to focus your efforts if you have the proper temperament for it, and a terrible place to get involved if you get frightened by markets that decline and get excited when stock markets go up. You have to check your emotions at the door when you invest. He didn't shy away from saying that yes, there are a lot of potential catalysts that could negatively affect the stock market, and yes, the AI craze is really stretching valuations. But the best thing to do is just stay rational and focus on what you can control. Just stick to bottom-up investing in areas that aren't being overrun with stock market speculators. Either that or simply exercise your patience. Remember Buffett's philosophy. You are not trying to pick a company to invest in every 6 months. Really, the big money is made when you wait patiently for the perfect pitch, and then when you get it, you swing hard. This always happens in speculative mania. People look at Buffett and they say, "Come on, swing already." And then they conclude that value investing is probably dead. Quite the opposite. Value investing just keeps us safe. Remember Buffett's first rule of investing, don't lose money. But then on the flip side, what happens if the AI bubble does deflate in 2026? What if trade policy sends the economy into a tailspin? Well, remember this. There have been 3 times since Buffett acquired Berkshire that the stock has gone down 50% in a fairly short period of time. 3 different times. Nothing was fundamentally wrong with the company at any time. If it makes a difference to you whether your stocks are down 15% or not, you need to get a somewhat different investment philosophy because the world is not going to adapt to you. You are going to have to adapt to the world. If the market tanks, so be it. As a net buyer of stocks over the next 40 years, I want prices to be as low as possible. As Buffett noted in his retirement letter, stock prices will move capriciously, occasionally falling 50% or so, as has happened before. But don't despair. The economy will come back, and so will the shares. So with that said, that is some Buffett wisdom applied to our 2026 investing situation. I'm Zuhair. Thanks very much for watching, and I hope to see you in the next video.